Good day, everyone. Our topic for discussion today is financial reporting. Under the financial reporting, we will be focusing on two major outlines: the introduction to financial reporting and types of financial reporting. Financial reporting is a process of producing a statement that discloses an organization's financial status to management and other stakeholders. Financial reporting is the only way stakeholders can have an understanding or a feeling of what is happening to a business. Stakeholders are not limited to the management. Other stakeholders who have interest in a business are even the government. We have the creditors, we have the debtors, we have tax authorities, we have competitors, even we have potential investors. They all have interest in a business. So, because they are not physically involved in the day-to-day activities of the business, they rely on the financial report. So the financial report gives them a snapshot of what is happening to the business. All these stakeholders, they have different reasons why they are interested in the financial report of a business. For example, the government is interested in the performance of a business solely because of tax. Because if the business is doing well, definitely the business will pay more tax. For the shareholders, they are interested in the business because they want to get more return for their investment. Likewise, a creditor is interested in the business because they want to know if the business can repay back the credits, this goods supplied to them on credit. Likewise, the staff is also a stakeholder in a business. The staff will be interested in order to know if their employment is still secured. All these stakeholders need the financial report in order to ascertain the financial status of the organization or the business. Financial reporting have different reports. We have a report called profit or loss statement. A profit or loss statement, in other words, is called statement of income. What a profit or loss report shows whether the organization or the business is making profit or loss. As we can see on this table, we can see the items under income. These are interest on loans and advances and other income. This table shows us that this profit or loss report is from a financial institution, that is the bank. Their major income flow are interest on loans, where they've generated a 147,000 plus, and other income that amounted to 229,000. The total sum of the income generated within that period is 377,000 plus. We can also see the expense. These are just snapshots of the expenses. They've expended a total of 2,126,000 plus, as against the income of 377. What this shows us is this business is making a loss of 1,748,000 plus. That is the status of this business. So a statement of income shows us whether a business is making a profit or a loss. We also have a report called trial balance. A trial balance, as we can see on this table, has all the various categories of accounts. On the first column, we can see assets, we can see expense, we can see liability, we can see capital and income. These are the 5 major categories in accounting. And on the second column, you can see the various general ledgers. You can see the cash and bank balance. Cash and bank balance means the cash the business has either in their safe or in the bank. This amounts to 20 million. We can also see loans and advances. These totals the total amount of loans and overdraft they've given out to customers. We can see under expense, interest expense, we can see staff cost. Under liability, we can see deposits and other liabilities. Under capital, we can see capital and reserves. And under income, we can see interest income, fee income, other income. The major thing to look forward to in the trial balance is that the sum of total deposit must be equal to the sum of total credit. As we can see on this table, that the sum of total debit is equal to 42,167,150 naira 96 kobo, which is the same thing on the credit side. Where the two columns are not equal, that means there must have been an error along the line in preparing this report. So a trial balance is a type of report that shows us the sum total of all the individual ledger balances. For example, we have cash and bank balances on the first row. Under these cash and bank balances, there may be up to 10 or 20 general ledgers whose the system have summed up to amount to this 20 million. So it's possible you can have a general ledger that has 1 million, another one that has 5 million, another one that has 10 million. For a trial balance, what a trial balance does is that a trial balance will go through the system and sum all those balances that falls under cash and bank balances and report them on a trial balance. So a trial balance shows us a summary of the balances in various GLs. We also have another report called the balance sheet. The balance sheet is also referred to as statement of financial position. What this report does or shows us is it shows us the financial position of a business. On this table, we can see assets, we can see liabilities, we can see shareholders fund. If you can still remember the accounting equation that says total assets must be equal to capital plus liability. Here you can see that total assets is 38 million plus, total liability is 5 million plus, total shareholders fund, which is also the same thing as capital is 33 million plus. So if you had 33 million plus 5 million under total liability, it will equal total asset, which is 38 million. A balance sheet shows how a business is expanding its resources. A balance sheet shows us how the business has been utilizing the capital used in starting or expanding such business. We also have another report called Statement of Change in Equity. A statement of change in equity is a type of report that shows us relationship between the element of capital. Element of capital here are, we have the share capital, we have the share premium, we have the retained earnings, we have other reserves. If there is a change within or amongst these four major capital structure, a change in equity report must capture such changes. As we can see under changes in equity for 2015, we can see payment for shares. Previously, prior to this period, the balance under this share capital account is 100,000 naira. Within the year, there was a movement, there was a payment for shares, as payment for additional shares of 5,000. So the balance moved from 100,000 to 105,000 as at the end of that year. So this is a change, and the change in equity report captures all these changes. We can also see another change under share premium. Share premium, the prior balance as at 1st of January 2015 was 50,000 naira. Within the year, there was share allotment posting that resulted into a share premium of 1,000 naira. And as we can see that the closing balance after the end of the year rose to 51,000. So a change in equity report is a report that tracks changes amongst the capital structure. Capital structure are share capital, share premium, retained earnings, and other reserve. Thank you very much.